It's the mortgage calm before the storm. G'day everybody, it's Leith Van Onselen, the unconventional economist, coming again with another macro breakdown, where today I want to talk about the Reserve Bank of Australia's latest data on Australian mortgage debt. The Reserve Bank of Australia has released Australian household and mortgage debt data for the fourth quarter of 2021, which showed that the ratio of aggregate mortgage debt, that's total mortgage debt across the economy, rose to a record high 142% of aggregate Australian household disposable income in the fourth quarter of 2021. The ratio of household debt also rose to a near record high 186% of household disposable income in the fourth quarter. Despite the fact that Australia's mortgage debt has increased to an all-time high, actual mortgage interest payments as a percentage of household disposable incomes fell to a 28-year low of just 4.4%. That's shown in the red line on the left-hand chart. This is because the fall in interest rates, as shown on the right-hand chart, has more than offset the overall rise in household debt. There is a sting in the tail, however. The principal and interest repayments, as a ratio of household disposable income, are starting to rise. That's shown by the green line in the left-hand chart above. This is because rapid house price growth has increased the principal share of debt repayments, which has more than offset the reduction in the interest component. Economists and markets are now tipping fairly sharp rises in Australian interest rates. At the low end of the range, the Commonwealth Bank of Australia is tipping the Reserve Bank of Australia's cash rate to rise by 1.1%, whereas the financial markets are at the high end of the range, and they're tipping that Australian interest rates are going to rise by 3.5% by August next year. If CBA's forecast comes to fruition, it would see mortgage repayments rise by 14%, which would add $380 a month in mortgage payments on the median priced Australian home. However, if the market's forecast of a 3.5% rise in interest rates came to fruition, it would see mortgage repayments rise by a whopping 48%, which would add $1,280 a month in mortgage repayments on the median Australian priced home. Irrespective, Australia's household debt burden, that is both principal and interest repayments, a percentage of household disposable income, are projected to rise significantly. Australian principal and interest repayments would shoot way past the 2008 peak under the market's forecast, as shown in the solid red line above, whereas it would rise to pre-COVID levels under the Commonwealth Bank of Australia's forecast of only 1.1% rise in Australia's cash rate. The bottom line is that interest rates will soon begin to rise, most likely from the third quarter of this year. However, it is my view that the Reserve Bank of Australia won't increase rates nearly as aggressively as the markets are tipping, i.e. 3.5%. This is because it would crash the housing market and the economy. I'm firmly in the CBA's camp on interest rates for the simple fact that Australians are carrying so much debt that larger rate rises risk crashing the housing market and smashing the Australian economy, potentially pushing it into a deep recession. Respectively, we are currently experiencing the calm before the mortgage storm, with repayments about to lift materially. And this could place a significant number of highly leveraged borrowers under extreme mortgage stress. Anyway, that's enough for me today. Just a quick video to give you the latest on the Reserve Bank of Australia's mortgage debt statistics. Just a quick note, I'll be on leave for the next 2 weeks, holidaying the Gold Coast. I'll be back after that, posting twice a week. So I'll see you in the next video. Thanks for watching.